Hello and welcome to the Lolly Investor Programme. Having had a go at talking about the Bank of England's quantitative easing programme last time, this week I'm going to tackle another big economic story of our time. What is being done to solve the eurozone debt crisis that is casting a dark shadow not only over the UK, but the global economy? Earlier this month, the European Central Bank unveiled its most ambitious attempt yet to prevent the euro from breaking up. For a short moment, it looked like the ECB had given people like me a gift when talking about what it was doing. It was reported that the ECB initiative was going to be called MOT, which is why I'm standing in the Citywire car park. Unfortunately, by the time ECB President Mario Draghi stood up in Frankfurt to announce his plan, the name had changed to OMT, standing for Outright Monetary Transactions. Someone had got the letters the wrong way round. Nevertheless, the idea of an MOT is a good one. The question then is, did Draghi and the ECB pass the test? Have they done enough to save the euro? The big idea behind OMT is that the ECB will buy lots of government bonds of the most indebted eurozone countries. This will push the price up of these bonds and reduce the yields, which will cut the amount of interest these countries have to pay on their debts. There are 5 parts to OMT. First, it is unlimited. The ECB says it will buy as many bonds as it takes for markets to get the message that countries like Greece, Italy and Spain are not leaving the euro, that the single currency is irreversible. Like the Bank of England, the ECB can create new money to fund these bond purchases, so it is a really powerful player. Secondly, there is one big string attached. To get this help, countries have to apply for aid from the European bailout programmes. This means they'll have to cut spending and raise taxes, probably under the eye of the International Monetary Fund. Thirdly, the ECB will only buy short-term bonds of between 1 and 3 year duration. In other words, this massive intervention in the bond markets is only meant to be temporary. Fourthly, the ECB will not put itself ahead of other bondholders. If the countries it helps default on their debts, it will lose money alongside other bond investors. This is important because it encourages investors to continue lending to the weaker eurozone countries. Last but not least, the OMT purchases will be sterilised. This is a classic piece of banking jargon, but what it means is that the ECB will put the OMT through the car wash, removing as many euros from the system as it injects via the bond purchases. In other words, it is giving money with one hand but taking it with another. This is highly significant because it means the ECB is not embarking on the quantitative easing of the Bank of England or the US Federal Reserve. It is not increasing the amount of euros in circulation, which German Bundesbank President Jens Weidmann fears would be highly inflationary. It is simply taking big steps to ensure that government bond markets work properly, so that when the ECB cuts interest rates, countries like Spain and Italy get the benefit. This bold or desperate move by the ECB is its latest attempt to grapple with the eurozone debt crisis. There's no guarantee it will work, although markets soared after the announcement. A big fly in the ointment is that Spain and Italy are desperate to avoid the humiliation of asking for a bailout in the way that Greece, Ireland and Portugal did. They may have no choice, however. Also, once OMT starts, can it be stopped? If a country fails to cut its debts, would the ECB stop buying its bonds? Critics doubt whether the central bank has the political will to pull the plug this way. And even if OMT does work, it does nothing to help the southern European economies grow their way out of a tough recession, which is at the root of all their problems.